Have you heard about the widow's penalty? This is a tax penalty that one spouse has to pay after the other spouse passes away. The surviving spouse actually can pay more than double in taxes after they lose their spouse.
This is absolutely a real thing, Amber. So as you know, I prepare taxes for a lot of clients. So we have professional tax software. We're going to show you some examples of how this works in reality.
Okay, so tell us a little bit more about the widow's penalty. What does that look like for a real married couple?
I'm going to put the definition on the screen here for you. The widow's penalty refers to the financial disadvantage the surviving spouse faces after the death of their partner, resulting in higher taxes even on reduced income. So this makes sense, right, Amber? You have a husband and wife who are married filing jointly on their tax returns. There are two taxpayers. When one passes away, there's only one taxpayer who now must file as a single individual. So it's, we call it the widow's penalty, but it applies whether the husband or wife dies first. Doesn't matter which one. We're simply going from married filing jointly to a single individual, and the taxes more than double.
So give us an example. Let's see some real numbers of how this works.
Okay, on the screen, we're going to show you Bob and Kay. Bob and Kay are both over age 65 in 2025. Now, Amber, I know we're in 2026, okay? Most of our viewers just got done filing their 2025 tax return. So these numbers are very accurate for that. Also, that's the year we have tax software for, right? We can run Bob and Kay scenario through our tax software and give you actual numbers for 2025. So here's what that looks like for Bob and Kay. Bob and Kay, both over age 65, so you get the extra senior deduction. Bob's Social Security is around $30,000, Kay's is around $20,000, and they're taking out $50,000 a year from their IRAs. So their household income is $100,000. You're with me so far?
I'm with you.
Okay. Now, believe it or not, $100,000 of income, when half of it comes from Social Security, their federal tax bill only $3,800. That's reasonable, right? 3.8%, that's a pretty good tax rate. Life is really good if you're paying 3.8% federal income tax as a married couple.
Absolutely. Okay, so show us what happens then when Bob passes away.
Okay, again, in our scenario, Bob passes away, Kay is left. Now, what happens when a married couple once passes away? You go down to one Social Security check. So Kay is going to drop hers and take Bob's. So she gets $30,000 from Social Security now instead of $50,000. But she wants to maintain her lifestyle, Amber. So she wants to have $100,000 of income. Where's she going to get the extra money after $30,000 from Social Security? She's going to take it from what?
Her IRA.
Her IRA, right? That's the only other place she can pull it from. So she's going to pull $70,000 from an IRA now. Look at these numbers. Unbelievable. If she wants to maintain her lifestyle at $100,000 of income, her federal tax bill jumps from $3,800 to almost $11,000. Amber, that is more than double. That is nearly triple. Do you see that? This is federal taxes only, not state. Just federal, more than doubles for our widow Kay in this example.
That's pretty astounding. So what if we say that Kay actually doesn't need the full $100,000? She's not spending quite as much when Bob's not with her anymore. So does that help a little bit?
Sure, that's fair. But I'm going to point out the only thing that maybe goes down is the grocery bill, right? Maybe some travel. But in all actuality, real estate taxes don't go down. Homeowners insurance doesn't go down. Utilities don't go down. So let's say, can we pick a number of, instead of $100,000 for just Kay that she can live on, say $80,000? Is that reasonable?
Sure.
A 20% reduction, but she has a similar lifestyle, you're saying?
Yes.
Okay, let's look at those numbers. I'll put them on the screen. So again, now she's going to live on $80,000. So the Social Security is the same. She's going to take $30,000 from Social Security. She's going to receive $30,000 from Social Security, I should say. She's going to keep $50,000 from her IRA like she originally had when Bob was alive for a total of $80,000. Look at that. Her tax bill is still $6,300. That's still 165% more than she was paying when she had 20% more income. So Kay is living on 20% less income and paying 165% more in federal income taxes. This is the widow's penalty.
So this is bad news. This is
terrible
not good.
news.
But
No.
there must be something that can be done.
Yeah, you got to have some planning. Okay, so we can't wait till one spouse is already gone. We need to do some planning. And here's what that is. I'm putting on the screen. You got to start converting these taxable IRA or 401k or TSP accounts, any tax deferred account, you need to start converting those to tax-free. There are 3 ways to do that. Depending on your situation, the other 2 might be available for you, but the one that is available for everyone is converting to a Roth IRA.
So how does that work? You just convert a whole IRA all at once to a Roth?
No. Again, depending on your situation and your other income, typically you will start to convert IRAs over a period of time, say 5 to 7 years. You'll take out a little bit, pay the tax that year. Next year, take out a little bit more, pay the tax, and we do that over time. So that at the end of the conversion, now we have this bucket of tax-free money. So go back to our scenario. Bob passes away and she wants to supplement her income from Social Security. She can do that from a tax-free bucket now instead of having all of the IRA money taxable.
So what happens if you start converting to a Roth IRA, but you don't get it all done before the first spouse passes away?
That's a great question. So say we have a 5-year plan, spouse passes away year 3. Well, we've already moved maybe 60, 70% over, so she has a tax-free bucket. But now what happens is the IRA value is dropped. So now the required distribution from the IRA is also lower. So we still have some play there. She can pull a little from the IRA and a lot from the Roth IRA, perhaps.
And reduce minimum distributions, you're saying?
Exactly right. Yep, exactly right.
Is there a dollar value or dollar amount that people should look at converting?
So I would say for married couples, if you've got, say, 400,000 or 500,000 or more in tax-deferred retirement accounts, yeah, we should start converting, and we can put together a plan for you to do that over whatever time period is correct for your situation.
So if you want to learn more about Roth conversions and how they work, you can watch our video that we put out a few years ago about Roth conversions. And then if you want to sit down and talk to Corey about it, you can go to our website and schedule a time when you can sit down and get your questions answered.
Yeah, again, there are actually 3 possibilities for converting to tax-free. The Roth is available to everyone, regardless of your situation. So we talk and see which one's going to be best for you.
So reach out to us. This is just one more way that you can make the rest of your life the best of your life.
Plan now to retire happy.